Good morning and welcome this morning to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson and I'm an education coach and senior manager here at Charles Schwab. I'm joined today out there in the chat by my good friend Barb Armstrong, another 20-year veteran of the financial markets. She's going to be there helping to answer your questions. Welcome to all of you. Thank you for being here. Great welcome from many of you. Janelle, thanks very much. I appreciate all the hearts there. And thanks to all of you who I have seen recently and connected with in our live workshops or on our social media feeds or here in the webcast. And thanks for being here, whether you're here in the live version or in the recorded version as well. Participate in the chat. That's why Barb's there. Also, if you're in the recorded version, leave your comments. Hey, it's index options today. We're going to talk about managing. I've been away for a couple of weeks. Out on the road doing some stuff, and Barb's been covering this class for a little while. So we're going to talk a bit more about some of the ideas and strategies that we've been discussing, number one. Number two, I wanted to explore the idea, because we've been focused on European style options. I wanted to explore the idea of indexes that maybe have American style options and how we might utilize those that maybe give us a little bit more flexibility. So let's do this. Couple quick housekeeping items before we get started here. Remember that everything we talk about simply for illustrative and educational purposes only, not a recommendation of any particular security or strategy or index or pattern or account type or anything else. Remember that equity and index options carry a high level of risk. They are not suitable for all investors. Make sure you're aware of the characteristics and risks of standardized options before considering any option transaction. Remember that multiple leg option strategy will involve multiple commissions, and that spread trades must be done currently in a margin account. Also, we're going to use some technical analysis in this discussion. That's not the only way to look at the market. Technical analysis, fundamental analysis, probability analysis, all are theoretical. None are guarantees as to what might happen. Now, we're going to be using specifically the Thinkorswim desktop software platform today, and primarily the paper money version of that platform. Not a guarantee of future success out there in the real world, but a great learning environment. Now, I want to make mention of this, and it's important to remember, but we got to put it in the context. American style short options can be assigned at any time up to expiration, regardless of being in the money, at the money, and out of the money. That risk is small, but it is there in that circumstance in those American style options. Many index options are European style indexes, and thus removes that early assignment risk. We'll talk about that. We've talked about it in this particular class over the last few months. Remember that the Thinkorswim paper money platform will not facilitate the early assignment of a short option. That's something you got to pay attention to as you move your practice from paper money to live. So we're going to point that out, and we'll talk about that in the context of this discussion. Remember that investing involves risk, including the loss of principal, and past performance of any security or strategy doesn't guarantee future results or success. Also, as we talk about stops, which we may not in this discussion, but if we put stop orders on, remember that stops don't guarantee the execution price, just the activation price, and a stop limit order could be gapped around and not fill at all. So let's jump into this discussion here really quickly. As we get into this idea, these are some of the strategies that we've been using with index options. And we've been kind of basing this on the context that index options give us that potential benefit of eliminating that early assignment risk. And I know that is a risk that is a circumstance where those American style options could potentially be assigned early. But I want to quantify that to a certain extent, and I want to kind of put it into the context of how big a risk that might very well be. And we'll talk about that in the context of index options. So we're going to look at American style index options today. There are a few of them, and we'll see what those look like. And we'll see why we might use those, because maybe it gives us a little bit more room. So Claudio asked the question, yeah, spread trades must be done in a margin account. Absolutely. That is a Schwab rule. Index options are typically cash settled. You're right. So that is the other benefit of, or one of the other benefits of using an index option as opposed to an equity option, because it is perhaps a bit more straightforward when it comes to settlement in the event of exercise or assignment. That option settles to cash instead of shares of the underlying. So you're not going to end up with a short position in the index or a long position in the index, because you can't be short or long in the index. The index isn't a tradable instrument. The index is simply an accounting of cash. So, and to Barb's point, and it's a function of the disclosures that we use. Spread trades can be done in some registered accounts, right? So SPY is not an index option, and it is not an index product. It's an index tracking exchange traded fund. Now, I'm going to just say this. We're not going to talk about it. We're not going to look at it. And there's a reason for that, because it is an ETF. If you're going to trade ETFs, make sure that you're aware of the characteristics, risks, charges, and expenses of any product that you are considering trading. Make sure you read the prospectus, but we're not going to use it in this particular discussion. So there we go. Let's jump into the market here. Take a look really quickly what's going on with the indexes this morning. Here's the S&P 500. I've already started to draw some lines on this chart. That's our 14 days away expiration time frame. Actually, that's 7 days away. So let's see if we can remove that drawing and we'll redraw that. But this morning, we saw a little bit of initial move to the upside, but not too much. It was just briefly that we saw kind of a green on the SPX. Now moving down, but starting to move back up a little bit, maybe giving us a bit of this hammer candle type perspective, right? Taking a look at the NASDAQ, seeing a little bit more bullishness. This is a gap down and a bit of a rally from yesterday's move. So gapping down from that 50-period moving average, starting to see perhaps a little bit of a rally. RSI turning over just a little bit, and taking a look at the Russell 2000, the small cap index, again, gapping down from this diagonal downtrend line and giving us this little bit of a hammer type of candle. Now, BJ, I like that. The hammer candle maybe gives us some enthusiasm about the possibility of a bounce here, but it's not quite there yet. It is the potential for a bounce, but it isn't quite there yet. So that's part of this possibility of upward movement here. Nevertheless, on these broad market indices, we're still well below the 200-period moving average. We're well below the 50-period moving average. Here on the SPX, I've kind of zoomed in. We're just off of that 50-period moving average. We're below the 200-period moving average, and the RSI is generally falling. Now, before we get into further discussions here about other indexes, I want to go back over here to our monitor tab, and I actually closed these trades down. So I know Barb talked a little bit about this last week because she and I discussed this when I was at the Advanced Options Workshop last weekend. Some of you were there. Thank you for being there. Barb was there. We had a great opportunity to talk with traders and investors in Dallas and talk a little bit about advanced option strategies. Oh, one of those that we talked about was using index options as a means to hedge your portfolio. So we're kind of at a blank slate here in terms of our index option strategy, which has been selling a vertical spread at 14 days to go until expiration, and then buying that back and closing it out at 7 days to go until expiration. So 14-7, 14-7, 14-7, and just doing that again and again and again. So I'm going to go back to my charts tab here, and I'm going to change my grid to a grid that we've looked at before. This is my index options grid. And we're looking at the S&P 500. This is the SPX. And that's what we've been using for this particular strategy, is this 14-7 strategy based on a particular characteristic. So the idea has been that when the SPX is above the 200 period moving average, we were selling put spreads. When the SPX was below the 200 period moving average, we were selling call spreads. And that idea of kind of taking that contra move to where the index was the idea of selling where the index was not likely to be and collecting premium, right? So here's the thought. We're still below, now this is the 50 period simple moving average. So we're below the 200 period moving average. So we're still in the position, we're still in the toggle of selling call spreads. So here's how we're going to put this together. We're going to blank slate here. Now, Jerry, this particular grid is linked. I put the link in the description page for this webcast. I will also share this when we are done so that you can replicate this. Left-hand side is a 1-year daily chart. Right-hand side is a 3-month daily chart, just so that we can see a shorter view. Left-hand side, I have the MACD histogram. Right-hand side, I have implied volatility. And I have the probability of expiring cone, which is a 1 standard deviation cone from where the price of the index is right now. So I know that 14 days from now, since tomorrow is May 1st, 14 days from now, that expiration is going to be May 14th, right? So that's going to be our expiration date. That's right here. And I drew this when I was prepping for this webcast earlier this morning. I drew that line at where that probability of expiring curve was. That's out here at about 58.45, 46. Notice what's happened with this probability of expiring curve in the last kind of 2 hours or so. That probability of expiring curve, the range of that probability of expiring curve has contracted, meaning the range has come in. The expected move has diminished. And that may be a function simply of the fact that implied volatility has overall stayed just about where it is. If we were to just quickly switch over here to our VIX grid, volatility moved up a little bit, but then it really started to come back in a little bit. And the volatility overall for the SPX and for SPX options is staying just about where it was yesterday and the day before, kind of right in this 25 handle. Currently sitting at about 25.69, which is about where it was yesterday. We saw a little bit of a brief spike. That may have been early on this morning what was expanding that VIX curve, or that probability of expiring curve. Now the VIX has come back in a little bit. That puts us in a kind of a narrower range. So what we're going to do is I'm going to zoom in on this right-hand side. I'm actually going to maximize this cell so that we can see it. I'm going to zoom in on this right-hand side so that we can get a little bit tighter view. And we're going to go out here to the 14th. And we're saying, all right, fine, here's where we are. Here's our expiration on the 14th, 57.96. I'm going to call that about 57.90, maybe 5800, depending, right? Kind of right in there. So 57.90 to 5800. I'm just going to draw a line right there. That's 1 standard deviation move, okay? And so that means that the expected move from where we are right now to that expiration, 14 days from now, is anywhere between here and down here. It's plus or minus that range. So that's the expected move. And that is, and you're right. So, George, there you go. About a 16 delta. So let's see if that matches up with our option chain. So I'm going to go to the trade tab. And we're going to open this up here really quickly. We're going to go out to the 14 May expiration. I've got 150 strikes here. And we said, all right, where were we price-wise on the index? About 57.90, we'll call it. So we'll go to the trade tab. We're going to scroll down in our option chain, which is up numerically on the call side. And we're going to get to that range. So here's our at the money. Index is currently trading at 55.05. There's our 55.05. That's our at the money strike. And you can see I've got delta here. I've also got implied volatility. So I'm going to go out once again to that 57.90 I don't have a 5790. I've got a 5800, or I've got a 5750. So George, we're just about right on. I mean, kind of right about this 15 delta is going to be that 5725, 5750. So a little bit smaller on the, if we were to look at delta, probability of expiring cone oftentimes will price a little bit further, kind of over expected move. We can look over here on the right-hand side, and that's 227, almost 228 points plus or minus between here and then. So we're kind of all in that same range, right? So that's going to put us right here. I'm going to kind of come in a little bit from that 5,800 range. And one of the reasons for that is simply, if I were to go 5,800, 5,900, that's a 100-point wide vertical spread. And I'm going to bring in a little bit more premium, but it's probably going to be a little bit more risk from that standpoint in creating that spread than I maybe want to take in this particular strategy. So I'm actually going to come in a little bit more, and I'm going to come in as far as that 15 delta. So that's the 5725. So we're going to be slightly inside that probability of expiring curve here, or the probability of expiring cone. So I'm going to sell, just to put this straight on now, I'm going to sell this 5725, and I'm going to buy the 5750. So this is a $25 wide vertical spread, and we're selling this $25 wide vertical spread for $4.20. Okay. So if we click on confirm and send here really quickly and we read through this, 420 compared to the 280. So let's see what that looks like. Let's take our calculator here and go $4.20 divided by $20.80 of our theoretical risk in the trade. That's about a 20% return on risk. Okay. That's about a 20% return on risk. We're inside that probability of expiring curve. Now, we could go a little bit tighter. Here's the thing, we could come back into the 57 or the 5,700 and the 5,725. We're going to get a little bit more premium. Now we're increasing our delta. So I want to be kind of right around that 16 delta. So I want to look right around this 5725. I'm okay with a 20% or a 25 wide vertical spread against the premium that we're bringing in this particular case. The thing about it is, if we take a look over here on this left-hand side, and the reason I put probability of out of the money is our short strike, the 5725, has about an 85% probability of being out of the money at expiration. Okay. So I never hear asked the question, why are the strike options so limited? Because look, we're now maybe 70 strikes. We're like 68, 70 strikes out of the money here in putting this on, right? So, from that standpoint, we're getting far out of the money here. The further out of the money we go, the wider that increment generally is. Because you see now we go to 200 points wide here, and 200 points wide, and 200 points wide. So as those start to see more demand, you still see that there's demand on these options, right? But because these bid-ask spreads are relatively tight. But if the market were to make a big move to the upside, these would start to tighten up. We would see tighter increments, because as we get closer to the at-the-money strike, you can see that we've got $5 wide increments between our strike prices, right? So we do have a 5750 for the 14 May. So that's the trade we're going to put together here for our 14.7. So here's the thought. We're going to look at selling this, the 5725, 5750, 25 wide vertical spread, and we're going to sell this, and I'm going to put this in my index options weekly. Okay. And I'm going to click on send, and we're going to fire that order off, making sure that we've read through that order, make sure that we're aware of any of the characteristics of that order, any alerts that we need to pay attention to. Now we've sold that position. Let's go out here to our index options weekly group, and we're short that 57.25 short strike. We brought in $4.20. We're going to look at buying this back next Wednesday, 7 days to go until expiration, come what may. Okay. We are not, in this particular case, going to manage off that risk. We've got $20. We had, in this case, $20.80 of risk, or $2,080 if we wanted to carry that out through the 100 shares. But the thing to think about here is the probability of expiring. This is, again, one of those scenarios, and I'm going to be cautious in saying this because I said this last time. This is at a 16 delta. Highly unlikely that this is going to get hit unless there's a rip-your-face-off rally in the market. Could there be a rip-your-face-off rally in the market? Yes. But here's the thing. We're so far out of the money, we're playing a disparity or a dispersion in time decay. Our far out of the money short strike, this one right here, has a time decay curve that looks like this. Okay. So we're going to get the majority of our time decay here on the front end of that position. The slightly further out of the money option that we are long has a very similar curve. But we're okay with that. We're okay losing a little bit of value on that because we're not in this trade for a very long period of time. We want to capture this rapid time decay on the short leg. That's the reason why we are selling at 14 days out and buying it 7 days out, buying it back, closing it out, and then moving to the next trade. Now, we could just roll it. Rolling is simply a convenience order of closing out one position and initiating another. Doesn't get by any magic wand or anything else. But here's the thing. This is a situation where if the SPX does start to rally, this could stay relatively inflated until we get closer to that 7 day time frame. We're not looking at holding this all the way till expiration. We're looking simply at buying this back at 7 days. So let's see how this goes, and we will follow up with this. Now, I know Barb last week talked about getting out of this trade when it's done the majority of the work that it can do, that 80% range, and that's fine too. For the integrity of the strategy that we've been doing here, I'm simply going to buy it back come what may. Whether it's done its job, whether it hasn't done its job, we're just going to buy it back at 7 days. You can do it either way. That's just fine. So that's strategy that we've kind of been working through in this particular discussion, in this particular webcast over time. Now, here's the other thing that I wanted to do. We've spent a little bit of time building watch lists. In fact, I've got a watch list here called Euro style indexes that we built. All right. And this is a list of optionable indexes that have European style options, which means they cannot be exercised by an option buyer until expiration, which removes early assignment risk if we are short. Okay. And what this also means, though, is you can see we've got the SPX in here. We've got XSP. We've got NDX. We've got XND. We've got the Russell 2000. We've got the Russell 1000. We've got the Dow Jones Index in here. All of these are optionable, and all of these are European style. But we're relatively limited because if we were to just go to this list, if we were to change our watch list to this in our public watch list, if we were to say, all right, all indices, right? If we were to just grab all indices, now, wow, we've got lots more to choose from here, right? There are a lot more indices than we're looking at. We've even got public watch lists that talk about European style indexes, and we've got a watch list that talks about American style indexes. Take a look at American style indexes. That gives us access to things like the oil index, the OEX, which is the S&P 100 index, the semiconductor index, and XAU. These are optionable, right? So let's take a look at this, say, for instance, the SOX, the SOX, right? So let's go to our charts. Let's go to our single grid. And let's take a look at the SOX here really quickly. SOX, this is the semiconductor index. We can see that that's been mirroring roughly the NASDAQ to a certain extent. But we can go to the trade tab and see there's the problem. Some of these American style indexes are not optionable. XAU, let's see if XAU is optionable. Now, XAU is optionable. Here's the challenge when we start to expand our watch list of indexes to American style indexes. And I wanted to do this just to simply illustrate, because this is a question that's come up not only in the feedback surveys, but also here in the chat. Why don't we use these American style indexes, right? Is that sometimes these American style indexes don't have a lot of trading liquidity. You notice that the XAU here in this particular case doesn't have weekly option expirations. And in fact, if we were to look at some of these regular option expirations, you can see that those bid-ask spreads are substantially wider, right? These are substantially wider than European style indexes, right? Yeah, there's still 1256 contracts, right? But the liquidity just is not there. You see these wide bid-ask spreads, which is the primary reason that we've been focusing our efforts on these European style indexes. And so as we look at these public watch lists, we can come down here and we can see all of these European style indexes. Now, these are all that are listed that have that are European style. The question is, how liquid are the options in these, right? So we can expand our view a little bit. We can open ourselves up perhaps to more international exposure by taking a look, say, for instance, in this particular case, at, say, for instance, emerging markets, or maybe a particular area of the market. So we can kind of focus, outside the US if we wanted to, right? So we could take a look at, say, for instance, the Euro S&P 100 index, XEO. So let's take a look at what that looks like. And it looks very much like the SPX. But we look at the trade tab here, and now on the XEO, we do have, again, those European style, but take a look at, as we get to our at the money strike, once again, the width of those bid-ask spreads becomes very illiquid and challenging to trade, right? So we came up with the idea of scanning and running that scan. Let's load our scan queries. And it was to create a Euro options index filter. And so we were looking at volume. We were scanning in European style indexes that intersected with all optionable. And we started to look for that movement and volume as a means to filter out those that traded with wider bid-ask spreads. So that's why we got back to this watch list of European style indexes, right? So now we have that list of European style indexes that generally trade with relatively narrow bid-ask spreads that are liquid tradable options. So there's a reason for the methodology here. There's a reason for the process of narrowing our list down to answer the questions that people are asking. Why do we just focus on these European style indexes? Why are we just focused on this relatively small list of indexes? Why can't we go out and find more opportunity, right? So again, I wanted to take a look. We've been focusing primarily on just a few choices. We've been looking at SPX, we've been looking at RUT, we've been looking at NDX, we've been looking at the MRUT, the smaller Russell. So just a matter of kind of focusing our efforts here. I wanted to take a look at some of these other indexes that are European style indexes that are more liquid when it comes to options, and look at maybe some of the challenges. So one of the questions was, well, why can't we look at something like the MSCI, the Emerging Markets Index? And so let's take a look at that really quickly here. That's MXEF. We know that this is European style. We know that it trades options, and we know that it has relatively liquid options. So let's do this. Let's go to the chart for MXEF. Here's the problem. Because this prices based on those emerging market index prices, we get lots of gaps. This is really gappy. Now, it does trade options, right? But it doesn't trade a lot of liquid options. It does not trade a lot of liquid options. The scan for Prakash for this European style index is actually, the link to that is in the description page. So we'll pop that back in here as well. So point here in this particular case is that we want to make sure that we are aware of what we are trading. We want to make sure that it meets the characteristics, and just casting willy-nilly around a watch list of indexes is something that maybe is fraught with a little bit of challenge, right? So let's take a look, though. I think there's some other opportunities here within this space to add some exposure. So, for instance, in my Trading Futures webcast yesterday, we looked at the move that the Japanese yen has been making. So we happen to have a yen index here, XDN, which is an index that tracks the movement of the yen versus the US dollar. This is priced in dollars. This is a dollar denominated. This is a cash settled index, XDN. So we're going to go to the chart, and you can see that that moves in kind of relative stability. There are some gaps, as there are in the currency market as well, but we're starting to see maybe this double top scenario here. So we can draw a line of support here. We can look at the trade tab, and we could look at the options that we've got here, and they've got relatively tight bid-ask spreads. Not a lot of demand in the sense that we have weekly expirations or daily expirations, but we can still use this, given the tightness of these bid-ask spreads, to create a strategy to take advantage of, say, for instance, yen movement. So we could look for, say, for instance, a directional move here. Right? We could create a directional trade, or we could even create a non-directional trade. And this is going to track pretty closely to the movement of the yen relative to the US dollar. So if you want to add currency exposure in European style index options, this is one way that you could go about doing that. So let's just do a directional trade here. I'm going to do, since we're seeing some upward movement here, my bias overall is higher. I'm going to do a long call vertical spread because I don't have assignment risk in this particular case, and look for some upward movement. Look for this to maybe make that move, right? So let's do this. Let's do a long call vertical spread in the yen index, looking for upward movement in the yen. So my thought process is, we'll buy where it is, and we'll sell where we think it's going. Buy where it is, sell where we think it's going. So currently, right now, we're seeing that price right around the $70 mark, and we're going to look to sell the other leg of our vertical spread right around 71. I think we might make that move back up to that point, simply based on technical analysis. So we're going to go to the trade tab. I'm going to go to this front month expiration. You notice that implied volatilities are relatively low here. So what I'm going to do is I'm going to buy the 70. That's where the index is right now. Buy that one. And I'm going to sell the 71. So we're creating a $1 wide vertical spread, one strike wide in this particular case, $1 wide for a net debit of 39 cents, which means that our maximum theoretical gain in the trade is 61 cents, right? So that's a trade-off that I'm okay with. I know that I don't have early assignment risk, and even if I did in a long vertical spread, that gives me the potential to realize maximum theoretical gain in the trade. So I'm okay taking this risk of what I'm paying for this option or this spread at about 39 cents or $39 carried through the multiplier for the potential of taking that maximum theoretical gain. Where does this have to be? It's got to be at or above 71 at expiration 16 days from now. Is that a possibility? Yes, based on our directional opinion here in this trade. So I'm going to go ahead and I'm going to click on send. We're going to fire that order off after I make sure that that is the trade that I want. I'm going to read through that order, make sure that I don't have any alerts here. And we're going to fire that order off. So we're now, you can see it's already starting to move a little bit here. This may be a trade that may take a little while to get put on here in this particular case. Yeah, so you might see that slippage, but in this particular case, so the slippage in this, I mean, we're looking at not huge bid-ask spreads. So the caution is always there. Make sure that you're aware of the amount of slippage that you might have in a particular trade. So Jerry asks the question, what about the amount of buying power? So let's recreate this trade. So I'm going to sell the one where I think it's going, and I'm going to buy where it is, right? And if I click on confirm and send, and I look at that buying power impact, that buying power impact, whoops, you know what I did? I didn't hit the control key. Let me delete that and we'll create this again. So selling the 71, buying the 70. Whoops. I was hitting my shift key, not my control key. That's not a good thing. Selling the 71, buying the 70. There it is. There's our vertical spread. Click on confirm and send and look at our buying power impact. $41. It is the net cost of this trade. Remember, there's not a dividend because there's not a dividend risk here in this particular case. There's not the risk of owning the shares and then the shares moving down. This is a cash settled index. So this is going to settle to cash. So the buying power impact, and this goes back to something that Barb and I have talked about the idea of specifically in light of the class that she teaches, which is trading a smaller account. Trading something like this in a European style index means that your potential gain is there, your potential loss is there, but you can manage your buying power impact so that it makes it an appropriate position size for that smaller account. And I know this is something that Barb talks about in that particular webcast. So it may take us a little bit to work that order on as we place that order, but that's something to pay attention to and adds a little bit of exposure to other products and other movement into our portfolio utilizing those indexes. And we've got a number of those that we can choose from here in this particular case. We don't necessarily just have to use SPX or XSP or NDX or the Russell 2000. That's where you're likely to find the greatest amount of volume, but at the same time, that's also going to be an area where adding some exposure could provide a little bit of balance and diversification in your portfolio. So you've got a number of different choices here within this space. Let's take a look at another one here. Let's take a look at the OSX, which is the oil index. Take a look at the chart here, and we can see what oil's been doing, generally making that move to the downside, rolling over a little bit after bouncing down from this resistance. So let's see what kind of trading volume we have in our OSX options. Not a lot and pretty wide bid-ask spread. So that's why I say you've got to pay attention. And you've got to take a look at where these products trade and with what kind of trading volume. So Vic asks the question, well, what if our XDN trade closed below 71? What if it didn't get to that point, right? Well, our max theoretical loss in the trade, let's go to our Analyze tab here, and let's bring up XDN, right? And let's look at our position, or our hypothetical position here in this particular case. Let's take a look at our hypothetical position. Oops. Actually, you know what we've got to do? We've got to do in simulated trading. So let's come back over here and let's create that trade once again in our simulated trading. So selling the 71, buying the 70. There it is down here. Oops, take that off, and we'll come back and take a look at our risk profile. There's our vertical spread, right? That's our long, tall, vertical spread. And if the price stops below or closes below 71, well, as long as it's above our break even, we're making some money in the trade, right? Remember, this is cash settled. If it closes below our break even point there, which is 70.41, that's where we're taking some loss all the way down to theoretical maximum loss. It's the same as any vertical spread, right? Okay. So Ted asked a question. Will zero open interest or volume for XDN hurt the fill possibilities? It could. The thing about it is, again, you're going to find volume in these trades. You know, that's why, again, it is beneficial to pay attention to what you're trading and seeing where there is more liquidity. One of the reasons why we've spent more time in some of these large indexes. I wanted to simply demonstrate, because of requests to, let's find other things to trade. Let's look at other indexes. Let's talk about some of the characteristics of those other indexes so that we're aware of why it is that we're trading what we are trading in the scenarios that we're looking at, right? We can always add additional exposure, but it's just something to pay attention to, right? So, yeah, and George, good point, right? So if it's not a product that is beneficial for us to trade, I mean, that's the thing. You look at something like the SPX, and we're talking about a very liquid product. We look at something like the NDX, we're talking about a very liquid product. Even in the XSP, right, we're talking about a very liquid product, and we start to look at those options, and you can see the very narrow, if we scroll down here to our at the money strike, a very narrow, generally bid-ask spread. Sometimes they widen up a little bit, right? But as we start to look at that possibility, that's where it behooves us to pay attention to. We can look at volume and open interest. Those aren't always the only indicators of liquidity, though, depending on the size of our position, right? Yeah, and Laura, if it's above 71, good question to ask. In that trade, is there any need to exit if this cash settled? There is not, because it settles to cash. And in fact, you can't exit, you can't exercise prior to expiration. You could close the position down, or you could simply leave that option or that vertical spread on through expiration, and it would settle to cash. So those are some of the characteristics here that I wanted to pay attention to. Let's just kind of quickly review. Let's take a look at our 14.7 strategy. We sold that vertical spread for 420. It's now trading at 415 to 420. It's working for us so far, at least to a certain extent. If we start to see the market moving back down to the downside in the SPX, then that's going to work more beneficially for us. This is somewhat of a hedge, but if we start to see this move back the other direction, time decay is going to be the thing that we're going to rely on in that particular scenario. And again, remember, these are not recommendations. These are simply illustrative and educational examples. And I wanted to spend a little bit of time talking about some of the choices that we have out there in being able to add exposure to our portfolio. But that comes with a caution. Pay attention to volume, pay attention to open interest, pay attention to liquidity, and make sure that we're trading in a liquid product. Guys, thanks very much. If you want to learn more about this and we want to spend a little bit of time learning more about index options, come over here to the Trader Talks webcast page and type in index, and you're going to see the full playlist for index options, including the stuff that Barb talked about, and lots of other great webcasts along the way. Make sure you click on subscribe and like if you haven't done so already. Make sure you follow Barb and myself on X, at Ben Watson CS, at Barb Armstrong CS. All of our other coaches' naming conventions are similar as well. I'm going to be back later today talking about getting started with Thinkorswim. So I look forward to seeing some of you there. Have a great day. My thanks to Barb Armstrong for helping out and our great production staff for helping to bring this webcast to you. Have a great day, everybody. Talk to you soon. Bye-bye.